Yeah, well, school's almost out for summer, but not quite. There's one more video to do, and I hope you don't give me any dirty looks. Anyway, the one video we got to do is monetary policy, the stuff that Janet Yellen, or you Yellen, does for a living, that Ben used to do for a living. Ben, he's my hero. And the old Alan Greenspan, the guy whose picture is on my office door. He's the Jolly Green Giant. Anyway, monetary policy involves the Federal Reserve Bank, all right? And the Fed has many responsibilities. It's a loaner of last resort. It has to manage the daily check clearing, and there's all sorts of things that the bank has to do, the Federal Reserve Bank has to do. But when it comes to the economic aspect of it, the role has expanded over the years since the Fed was founded in 1912. All right? So the role has expanded to the management of the nation's money supply, but not just for the sake of managing the checks and making sure all the numbers are correct. It's really in order to influence what happens in the economy. So, the variables we're about to mention are things we've dealt with either in prior months of the class or most recently in the past 3 or 4 class sessions. It is a group of variables that create a monetary policy chain. Now the chain that I'm about to draw out here, or delineate, is covered in Chapter 12, a small part of Chapter 12, page 196, 197. You can see the outline there, the outline I'm about to do. Make sure you're covering the monetary policy part, all right? At any rate, these people that lead the Fed, they have the power to control the money supply. So I write that as MS, money supply. They can do things to make it either go up or down, and when they do so, they will begin to influence the prevailing rate of interest in the economy. The rate of interest for commercial loans or commercial prime loans, housing mortgage rates, prime mortgage rates or subprime rates, car loan rates, credit card rates, etc. Obviously all those rates are varied themselves, but with that one decision about the size of the money supply and what direction to send it in, Janet Yellen, Ben, they can influence what the prevailing rates will be and whether they go up or down. Now, interest rates have connections to capital spending. So these chiefs of the Federal Reserve, they are expressly interested in influencing investment, capital spending. We've learned about that, of course. Durable plant and equipment owned by firms. I mean, as I go through this chain and the whole aspect of monetary policy, all the lessons that we learned through the course are going to come back and you're going to be reminded of them, or the whole course should really come together with this just one video, this one lesson. Anyway, so we first learned about that interest rate connection with investment when we covered Say's law and first examined credit markets. Remember again that one of money's prime functions is to act as a credit instrument, a means of financing. So firms borrow money at a certain interest rate, and that interest rate price does influence capital spending. It may not be a perfect linear sort of relationship. Keynes said that relationship tends to be volatile, but it's there and it works through time. So, now investment is part of aggregate demand. We covered demand and supply very, very early in the course, and then when we finally started covering macroeconomics, we started writing it larger, big capital letters, aggregate demand, because aggregate demand is composed of 3 things: consumption, investment, and government. 3 major spending flows. So if something happens in investment, you're going to have something happen in aggregate demand. And aggregate demand, in the end, is influencing prices and quantities. But not just the price of eggs or the price of books or the price of donuts or whatever. We're talking in the macro context. The Fed chief is interested in controlling, managing the rate of inflation and creating conditions in the economy for economic growth. If the economy doesn't grow, if there are problems, then what? The economy could go into recession. So obviously we want this aggregate demand to go up as much as possible. On the other hand, there's an inflation concern that emanates really from the 1970s and the oil crisis years, Chapter 3, that 70s show. And all these Federal Reserve chiefs, as I've mentioned in various classes, were all of this generation that saw or witnessed the 1970s inflation episodes, 9, 10, 11% inflation for various quarters throughout the decade. And nobody wants to go back to those bad old days. So inflation is a concern, all right? At the same time, growth, employment, and output in general, that's a concern. So there's something of a balancing act going on when it comes to managing this monetary policy chain, from the money supply itself to interest rates, investment, all sorts of capital spending for bricks, for lighting fixtures, for plumbing fixtures, for bricks, I said bricks already, computer hardware, whatever, okay? And at any rate, that's going to influence aggregate demand. So, there are multiplier effects working in the background, all right? And we're obviously involved with GDP stuff when it comes to C, I, and G, all right? So, all this is of concern. They manage it. They start with this, and the thinking is the effects follow from this, proceed from that, right? Like a series of dominoes, all right? So let's see what it is that the Fed chief can do. Trying to keep a good pace with this discussion because, well, that's not going to work. Oopsie-daisy. Try to keep a good pace because if I keep it under 20 minutes, then the video uploads a little bit more quickly, and that's all better for all concerned. All right? So, as you recall from all our work all semester long, everything comes in pairs. So, monetary policy decisions really come down to two things. There's only two things that Ben, Janet can do with the money supply. It either is going to rise or it's going to fall. And they can do things to manipulate that. But once they do, they set the chain in motion. So I'm going to examine the stimulative monetary policy in detail. That's what Ben and Janet have been using for the past 5.5, 6 years, right? Since 2008, when the crap hit the fan. All right, so the money supply goes up, right? That will have an interest rate effect, all right? I'll draw the credit market picture where loanable funds, money is available, right? And money being a stock allows me to draw this supply curve as a straight line. At any given time, there's 100 or 100 billion or 100 million or 100 whatever. There's X amount of dollars in the system. Like the amount of water in the pool of dancing waters. There's X amount of water in that pool. There's some stock of money available and in circulation throughout the money system. But the money's not for free. The credit is not for free. This is the credit market. Any borrower has to pay an interest rate. Now there's a demand, right? Firms that want to borrow money. If Janet follows Ben and continues this stimulative monetary policy, and that's her intention, even if she seems to be tapering off a little bit, if they increase the money supply, the interest price will surely go down. Because we're starting here at point A and moving to point B. Instead of 5%, it's 3% or whatever number you have in mind, just as long as it's lower than the starting number. All right? All because the Fed purposely pumped money into the system. All right? So there's your credit market picture. Money's becoming more available, less scarce, the price of it declines. Well, that will definitely encourage investment. All sorts of capital spending. Now, it might not happen quickly. It certainly didn't happen quickly when Ben very, assertively and aggressively tried to pump money into the system after the 2008 crisis and the recession was really starting to take hold. Firms in those conditions, those circumstances, when it gets so bad, get very pessimistic and refrain from capital spending. All right, so he tries to provide all the encouragement he can, or Janet will, but you can lead a horse to water, but you can't make him drink. And so capital spending may not react quickly, but at some point, low interest rates are a necessary condition for getting the economy to follow or initiate a growth pattern. All right? Now, once investment gets into the picture, we're back to the old multiplier principle of Keynes, where the spending is going to be having much more effect than the amount of investment itself. All right? Because one person's income is another person, one person's spending, I should say, is another person's income, and on and on and on, rounds and rounds of spending that are generated from the initial expenditure. So, now how you want to treat it from here, you can either go to aggregate demand and say, well, if the investment is up, I should have an arrow here, the investment will be encouraged, and that will lift aggregate demand, and that will have an obvious effect on the GDP, on the national income, whatever way you want to call it, whatever approach you want to use. One person's cost, another person's income. If aggregate demand is rising, these most crucial numbers in the whole entire macroeconomic field, they got to be rising. Because everything's moving in a stimulative sort of direction. All right, but where does that leave the economy in general? I'm going to draw the old aggregate supply and aggregate demand graph that we were covering when we were studying and preparing for for test number 2. Aggregate demand. Aggregate supply like this. All goods and services. All goods and services. Right? Our equilibrium is where it always is. Right? Where aggregate supply and aggregate demand come together, where they have their intersection. All right, so the economy is operating here, P1, Q1, right? If Janet starts or sustains Ben Bernanke's stimulative monetary policy, aggregate demand in the end will increase. What happens when demand increases? Roses in February. Demand increases, it rises to the right. Wherever demand rises, it rises to the right, like Sharika says. Maybe I should have some music from Sharika or Beyonce. It's funny, I never used any music from them. Anyway, let's see. What's the result? Well, one result is what the Fed is after in the first place. Q1 moves to Q2. Growth. The economy improves. This is the goal. This is the aim of stimulative monetary policy. The Fed wants to get the economy out of a recession, wants to get it out of an equilibrium where there's large, above normal, cyclical unemployment. All right? So it's aiming for growth. But in a sense, there's a price to pay, for lack of a better phrase. And you see there's this motion from P1 to P2. So the thinking is, or the reasoning is, yeah, this is definitely helpful on the growth side, but there might be a little increase in the inflation rate, a little acceleration of price increases. And that's the danger. That's the potential risk with stimulative monetary policy. Myself, I don't think the risk is always what these Fed chiefs seem to think it is, but I'm just a community college professor and they don't listen to me. Certainly it hasn't been a problem lately because our inflation has been very, very modest at like 2%. At any rate, they're doing everything they can over the past they have been doing everything they can over the past 6 years to try to create a growing economy and get this back, get the nation back on a more positive foundation, right, for growth and economic prosperity. So there it is, right? The monetary policy chain on the stimulative end, money supply up, the cost of acquiring money down, capital demand increases. I could have drawn a little graph there showing the demand for capital goods shifts to the right, creating multiplier effects that work all the way to the price level, creating some chance for inflation. That's the risk, but hopefully some increase in output and genuine growth, economic growth. So that's it. It's like, the leg bone's connected to the knee bone, and the knee bone's connected to the shin bone, and shin bone's to the ankle bone and the whole bone bit. It's a domino chain series of causes and effects, right? And once you see this pattern, once you see this logic, then contractionary monetary policy is just the opposite. Whereas stimulative obviously means to increase the money supply, right? And starts with that. There are times when the Fed decides the right thing to do is to shrink the money supply. And if they do that, then interest cost will increase because money is more scarce than it used to be. So is price. The price of acquiring it, acquiring credit, the use of money for that purpose, for financing, that goes up. So investment will be discouraged, and that sets the chain, or puts the chain like at another level, and we have multiplier effects that are working negatively. So aggregate demand will fall. GDP, national income, I'm not sure this is going to be seen in the video, I hope so. GDP will decline. That's decline that way, right? What would that look like? Well, I'm not going to draw it here because it's probably